So today's question, we're going to touch on something that we get asked a heck of a lot of times from clients, which is how to maybe consider buying property, whether it's your, I suppose, first starting point in buy-to-let, or whether you're looking to grow a big portfolio and you've already got some already. Tax is certainly a key consideration with that. Now, tax is obviously going to be a very wide topic, but I guess from a investor's viewpoint, there's certainly been lots of changes in the market with buy-to-let, tax changes, let's say, with purchasing property, stamp duty, holding property, interest costs, things like that. How do you see that playing into the crowdfunding kind of space? Do you see there's any, let's say, potential from investors to get something that's slightly different from what they currently kind of have opportunities for?
Yes, well, I think the big change over the last few years is the government has changed their tax laws to basically disincentivize individuals from investing in buy-to-let property. So up until recently, it was possible to offset mortgage interest against the income that you generate from a property, from the rental. And therefore you would only pay personal tax on the profit after mortgage. Now that mortgage relief, as it's called, is being slowly withdrawn, and a lot of buy-to-let investors may not have closely followed this and won't realise until they have to do their
and it's also being tapered, isn't it, over the next couple of years? So there's an element of when their tax return comes around, or they have that conversation with their accountant, it's like, oh, actually, there's
that's right. So a number of people will get quite an unpleasant surprise, say in their 2019 tax return, when they realise that tax shield, as we call it, from the mortgage interest has been gradually withdrawn, and in some cases that they'll end up, if they own 3 or 4 or 5 buy-to-let properties, that the income tax they'll have to pay on the gross rent will actually exceed the profit they make on those properties. So why do I mention that? Is because through property crowdfunding and certainly in Property Partner, we invest through companies. So each property that we buy, or a group of properties, is put into a company, and that company then can raise a mortgage. And because it's a company, it still gets the benefit of offsetting that mortgage interest against corporation tax. So although the company will still pay corporation tax, it'll be after mortgage interest. And therefore, in essence, it's a bit like it was for buy-to-let investors in the old days. Now, how are buy-to-let investors addressing that? Well, some of the bigger ones are incorporating, so they're moving all their properties from being owned personally into being owned by a company. That's not always easy because they have to essentially sell them from their own ownership into a company, and there's capital gains tax issues, etc., that arise. But you can avoid all that by investing via a crowdfunding site that has this corporate structure already set up and maintain those tax shield benefits. So something to look very carefully at if you're thinking of investing in property and looking at the buy-to-let route. I would advise people to look very carefully at the tax issues before they embark on a strategy, because it's sometimes quite difficult to unwind. It's never the headline gross yields, is it? There's always kind of something underlying that they need to kind of consider. And the other thing to think about, I mean, when you talk about yield, that's a very interesting point, because many people see yield as the figure that the rental on that property will generate, and they sometimes forget to take off all the costs that they'll have to incur in letting the property, maintenance, management, those incidentals, those void periods. In the better quality, I think, of crowdfunding sites, and certainly Property Partner, we always quote net yields. That's actually the yield that you will get into your account at the end of every month. And that very frequently is of quite a different figure from the gross yield, by a factor of 30 or 40%. So watch out that you're comparing apples and apples. And watch out for those tax changes. The stamp duty changes also hit buy-to-let investors, and as most people do understand now, buying a secondary property incurs additional stamp duty charges of 3% or so. So all in all, I think it tips the balance in favour when you add in the liquidity and the diversification benefits of crowdfunding investing as opposed to direct individual investing, it does tip the balance in favour of that. For an individual investor, very worthwhile to consider this.
I appreciate this is probably quite a rabbit hole type of question with property tax, but when it comes to, I suppose, the reasoning behind these tax changes from a government kind of perspective, do you see it more like a professionalisation almost of the market? They're trying to get companies to have ownership of properties because it makes it more open, I guess, or it makes it more professional in terms of the management and the running of those properties and the quality of properties being provided. And I guess by instance, do you then see that as a good thing for the market in terms of where Property Partner sits? That obviously the level of due diligence you go to from a sourcing and a management perspective aligns with that, I suppose, thought process.
Well, I think the underlying issue in the UK at the moment is there are just not enough properties for the numbers of people who want to buy them. And I think there's a political consensus that the growth in buy-to-let has perhaps resulted in a reduction of available properties to buy. Yeah. Now, you need a pretty advanced economics degree to really understand how the property market works, and I think there are several arguments to say that withdrawing or making it more difficult for properties to be let out won't necessarily fix the underlying problem that government's trying to fix. However, I think it is true to say that in general, everyone would agree that landlords who are not treating their tenants fairly and operating with proper regulation and doing things right is undesirable. And certainly, at Property Partner, we manage nearly 1,000 individual units now, and we try and do a very solid job and a fair job and treat our tenants in the best way possible. And I think that is a professionalisation of letting, and it's a positive thing. So there's a lot of political interest in this area and different pressures coming from different points, but I think it would be good to see the letting industry play a good game and
keep standards up.
Keep standards high. Exactly.
Fantastic.